The average New Zealand investor is $47,000 poorer over 20 years because they made one choice wrong. One choice. And most of you watching this have already made it without realizing. Quick question. Are you investing money into KiwiSaver, managed funds, or direct shares right now? Are you totally confident you know why your money is going into either the NZX or the ASX? If you answered no to either of those, this video is going to save you tens of thousands of dollars, possibly more. Here's the situation. Over the past decade, the NZX has delivered 2% annual returns. The ASX has delivered 1% annual returns. That's a difference of 9% per year. Now that doesn't sound huge until you actually run the numbers. Put $50,000 into the NZX at 2%, and after 20 years you've got $237,000. Put that same $50,000 into the ASX at 1%, and you've got $284,000. That's $47,000 more, just from picking the right market. And look, I know what you're thinking. Isn't that just the past? What if the past decade was a fluke? Here's the thing. The ASX is actually more diversified than the NZX. It's got more sectors, more companies, more liquidity. The NZX has got 200 companies on it. The ASX has got 300. When you've got that many more opportunities, the odds shift. But here's where most Kiwis get this wrong. They think it's binary. They think you either invest in the NZX or you invest in the ASX. That's not how this actually works. The real question is the ratio. Let me walk you through exactly what I mean. The average Kiwis KiwiSaver fund, and I'm talking about the default balanced funds that 60% of Kiwis are in, they're overweighting the NZX. They're putting about 35% into New Zealand assets and 65% into international assets. Now here's the thing. That 65% international is mostly Australian, American, and European. It's not evenly split. So when you look at what's actually happening with your money, you're getting crushed on two fronts. First, you're overexposed to the NZX because that's the default in Kiwi funds. And second, your international allocation isn't optimized for where the best returns actually come from. Here's the math. If you've got $50,000 in a standard balanced KiwiSaver fund, you're paying about 1% in fees. That's $550 per year on a $50,000 portfolio. Over 20 years at an average 9% return, those fees cost you about $18,000 in lost compound growth. But here's what actually kills you. You're not just paying 1% in fees. You're also holding the NZX position, which historically underperforms, and you're paying fees on top of that underperformance. Let me give you the clearer picture. Someone in a standard Kiwi balanced fund with $50,000 invested for 20 years at 8% returns, which is what these funds actually deliver after fees, ends up with $232,000. Someone who takes that same $50,000, puts 30% into NZX index funds at 0, 25% fees, and 70% into ASX index funds at 0, 25% fees, and gets historical returns of 2% on the NZX and 1% on the ASX, they end up with $271,000. That's $39,000 more, just from understanding the ratio and cutting the fees. Now I need to be really clear about something. This isn't me saying dump the NZX entirely. You need some New Zealand exposure for tax reasons, for currency diversification, and honestly, because you understand the NZX better than you understand overseas markets, you're less likely to panic sell something you understand. What I'm saying is the default 35% NZX, 65% international split is wrong for someone who actually wants to maximize returns. It should be closer to 25% NZX, 75% international, with the international weighted heavily toward the ASX. Here's why this matters right now specifically. The ASX has had 12 months of stronger performance than the NZX. You're watching the gap widen, and most Kiwis are doing absolutely nothing about it because they don't understand what's happening under the hood of their fund. Okay, strategy 1. If you're in a managed fund, you need to move to index funds. Right now, this is the non-negotiable first step. A managed fund charges you 1% per year. An index fund charges you 25% per year. On a $50,000 portfolio over 20 years, that's 85% difference in fees costs you $32,000 in lost growth. Strategy 2. Once you're in index funds, rebalance the ratio. 30% into an NZX index fund, 70% into an ASX index fund. You can do this through your KiwiSaver provider if they offer it, or you can do it yourself through a platform like Sharesys or Investno. Strategy 3. This is the one most people skip and it actually matters. Set up automatic monthly contributions. If you've got $50,000 already invested, start adding $300 per month to that portfolio. After 12 months, you've added $600. After 5 years, you've added $18,000. A blended 9 1% return. That $18,000 compounds to $27,000 over the next 15 years. So you're putting in $18,000 and getting $27,000 of growth just from the magic of compound interest. That's 50% return on your deposits. Let me show you the full picture now. You start with $50,000. You move it from a managed fund to index funds, saving 85% per year in fees. You rebalance from the default ratio to 30% NZX, 70% ASX, and you add $300 per month from this week forward. After 30 days, you've saved about $350 in avoided fees, and you've added $300 to the portfolio. That's $650 you wouldn't have had if you did nothing. After 1 year, assuming historical returns, you've got $59,000 in the portfolio. You've contributed $600 and you've earned about $800 in growth minus the fees you saved. That's $800 your money made while you slept. After 5 years, you've got $98,000. You've contributed $18,000 yourself. Your money has earned about $47,000 in growth. Your $50,000 starting position has nearly doubled. After 20 years, you've got $407,000. You've contributed $122,000 yourself. Your money has earned $285,000 in pure growth. That's the compound effect working. Now compare that to staying in the managed fund doing nothing. Same $50,000 starting point, no additional contributions, staying at 1% fees, staying at the default ratio. You end up with $232,000. That's a difference of $175,000 over 20 years. $175,000 for making 2 changes and being consistent with a $300 per month contribution. You know what most people do when they see a number like this? Nothing. They close the video and keep their money exactly where it is because changing is intimidating and the status quo is safe. And their bank is absolutely counting on that. Here's your action plan for today. First, log into your KiwiSaver provider right now. Write down what fund you're in and what the fees are. If the fees are higher than 5%, you're being overcharged. Second, find out what the asset allocation is. If it's more than 40% NZX, you're overexposed to the local market. Third, look at your provider's index fund options. Most of them have one. That's it. 3 things, takes 30 minutes maximum. Your next step this week is to switch into the index fund and rebalance the allocation. Then set up a recurring monthly contribution of whatever you can afford. Even $100 per month compounds to real money over 20 years. This is honestly one of the better moves available to any Kiwi under 50 right now because the math is so straightforward and the impact is so massive.